So the next concept we are going to discuss is accounting treatment of bad debts, provision for doubtful debts, provision for discount on debtors and creditors. So this concept we are going to discuss, sir. First, we are going to focus on the accounting for bad debts and provision for doubtful debts. Very, very important topic, sir. So in examination, there are chances that this topic may come. Usually, they will ask a question from this topic, sir. So let us focus on this. Accounting treatment of bad debts and provision for doubtful debts. Accounting treatment of bad debts and provision for doubtful debts. See, what is this concept is all about? Accounting treatment of bad debts and provision for doubtful debts. Let me give you a brief idea about what is this. See, when goods are sold on credit basis, when goods are sold on credit basis, the party to whom we have made the sales, from that party we need to receive the amount, right? That is called basically the debt. That is called basically the debt. So debt means in this context the amount which is receivable from the customers, or the amount which is receivable from the parties to whom we have sold the goods. Okay. So the first point you need to remember is, please write down the notes. When goods are sold on credit basis, when goods are sold on credit basis especially, the amount receivable from customers, also we call them as what? Debtors, correct? The party to whom we have sold goods on credit basis, that party is called our debtors. This is called debt. When goods are sold on credit basis, the amount receivable from customers or debtors is called debt. Now tell me, when any amount is receivable from anybody, so is there any risk here? Definitely the risk is there. Some parties will pay the amount, some parties will not pay the amount. Some parties, even though they want to pay but they become insolvent, they are unable to pay the amount. So obviously there are lot of risk is there in respect of these debts, the amount which is to be collected from the customers. So as a business enterprise, what you need to do at the end of the year, on the basis of chances of collection from the debtors, they will be classified on the basis of chances of collection from debtors. For example, sir, I have given some amount to 1 lakh rupees to Purna, 1 lakh rupees to Abdul, 1 lakh rupees to some other person. Now, suppose after I have given the amount of 1 lakh, Purna said, sir, I will give it within 10 days. I asked him after 10 days. He said, sir, please give me another 5 days. I have given another 5 days. He said, sir, I am in very difficult situation. Please extend time another 5 days. I also given another 5 days. Every time I am asking, he is telling wait for 5 days, 5 days, 5 days, 5 days. Now that means as a business enterprise, there is a risk for me, whether this amount will be collected or not. Actually, the debt is what? It is my asset. Customer account, debtor account is my asset. Now there is a doubt that whether this asset will be realized or not. Now tell me what I need to do. I know that there is a risk. Some of the debtors will not make the payment. So I have to ready for that loss. That's how the concept of provision for doubtful debts came. Wait. So therefore, when we sold goods on credit basis, we need to receive the amount from the parties. That is called basically debt. Now, the second point is on the basis of chances of collection from debtors, on the basis of chances of collection from the debtors, debts are into classified into three categories. On the basis of what, sir? Chances of collection, sir. On the basis of chances of collection. Chances of collection from the debtors, debts are classified into three categories. What are those? Good debt. Good debt. Good debt means amount is likely to be realized in full. Amount is likely to be realized in full. B. Bad debts. The amount which I given to Purna is a bad debt. I have a doubt. Bad debt means what? See, no doubt. 100% pakka it will not be collected. Confirmed loss. That's why it is called what? Bad debt. Bad. Sir, what is this good to bad like a child? That is the word they are using. Good means good debt means amount is likely to be realized. Bad debt means it is not going to be realized. So it's a loss, 100% loss, bad debt. That's why these bad debts directly we will transfer to P&L account. Because it's a 100% loss, sir, bad debts. We are not required to create any provision for bad debt. Bad debt is a loss, confirm loss. But one category is there. Not good, not bad. It is doubtful debt. Doubtful debt. Doubtful debt means whether it will collect or not, we don't know. We have a doubt. Collectability is not certain. We may get, we may not get. Doubtful. We don't know. So, good debt means what, sir? Likely to be realized in full. Likely to be realized in full. They are likely to be realized in full, sir. But this is bad debt is a confirmed loss, uncollectible or irrecoverable. Irrecoverable. Or we can say a confirmed loss. Confirmed loss. Bad debt is what, sir? A confirmed loss. And what about doubtful debt? Collectability of which is not certain. Collectability or collection is not certain. Collection is not certain. That's why it is called what, sir? Doubtful debt. Collection is not certain. Collection is not certain. Now you tell me, sir, out of these three, which is confirmed loss? Bad debt is a confirmed loss, correct? Will you wait? No need to wait. It's already bad debt. It will not be collected, irrecoverable. So when it is a confirmed loss, it cannot be recovered from the customer. What you do? It's a loss directly transferred to P&L account and also deducted from the debtors, because it is loss on one hand. Loss will be shown in the P&L account income statement, which is debited. At the same time, this loss is reducing my asset value. Debtors is my asset. So therefore, say this. How bad debts is accounting for bad debts. Basic accounting treatment I am explaining, sir. If it is a bad debt, it's a confirmed loss, sir. If it is a bad debt, it is a confirmed loss. which cannot be recovered from the customer. So what we need to do, directly transfer to P&L account, directly debited to P&L account as a loss. And one more thing we need to do, what is that? Deducted from debtors. Deducted from debtors. So since bad debts is a confirmed loss which is directly debited to P&L account and deducted from the debtors. So what is the entry? Bad debts, since it is a loss, it will be debited. Debit all expenses and losses, and we will reduce from debtors. Debtors is basically asset. Now asset value is reducing. So debtors, sundry debtors account will be created. Correct? Sundry debtors. That means bad debts will be shown in the balance sheet by way of deduction from debtors. Okay. Now, listen to me, the next thing, which is doubtful debts. So bad debts treatment you understood. Bad debts is what? Confirmed loss, which is loss means it directly transferred to P&L account. So what is the entry for bad debts? Bad debts to sundry debtors. Now I am talking about doubtful debts. Doubtful debts means what? Whether it will be collected or not, we don't know. Can we say it is confirmed loss? No, it is possible loss. For example, see, I sold goods to Abdul. Okay. Now I have a doubt whether he will make the payment or not. Doubt. If he doesn't pay, it is a loss for me. If he pays, there is no loss. That means there is no confirmed loss, but it is a possible loss. Possible means it may or may not. I don't know. Possible loss. So since it is a possible loss, can you write off directly like bad debts? No. You cannot write off like bad debts directly. This is only a possible loss. Bad debts is a confirmed loss which we will transfer to directly to P&L account. But doubtful debts is not a confirmed loss, na? It is a possible loss. So it cannot directly written off like bad debts. Then what to do? Simple. Create some provision to meet these future losses, possible losses. From the profits, create some provision. Since it is a possible loss, it cannot be directly written off like bad debts to the P&L account. Do one thing, you create a provision for doubtful debts. Sir, what is provision for doubtful debts? Estimate the amount. How much amount is not going to be collected? Estimate. How I estimate, sir? Based on past experience, estimate. You are doing this business. Last year, how much worth of or how much amount is not paid by the debtors? You have an idea. Our company can have a policy every year 10% on debtors. I will create a provision. I don't know because which debtor, which year he will not make the payment, I don't know. But definitely some of the debtors is not going to pay. That is pakka. So I don't know how much loss will come in future. But definitely a loss will come. Possible loss. So therefore what I need to do? I have to create a provision. Now the question is, sir, what is provision? A provision is nothing but an amount which is charged against the profits to meet any anticipated future losses or liabilities. So bad debts, doubtful debts is what? It's a possible loss. Write down possible loss. It's a possible loss. So therefore it cannot be directly written off. Directly written off like bad debts. Correct? Agreed or not? It cannot be directly written off like bad debts. Bad debts is a confirmed loss which is transferred to P&L account. But doubtful debts means it's a possible loss. It cannot be directly written off like bad debts. So what I need to do? create a provision for doubtful debts. Create a provision for doubtful debts. What is this provision for doubtful debts? It is nothing but an estimated amount of likely non-recoverable receivables or non-recoverable debts. So these are non-recoverable debts, sir. For that, you create a provision. You estimate how much amount is not going to be collected. For that, you create a provision. And now the question arises, sir, what is this provision is all about? Sir, provision is, I told you, is a charge against the profits. It is created against the profits. So what is provision, sir? A charge against profit. And why I am creating this? For the purpose of providing for any possible loss or liability. Correct? In future, any loss may come, any liability may come. Okay, to face that loss, what I need to do? I have to create a provision. Provision should be created from profits. That is why it is called charge against the profit, for the purpose of providing for any possible loss or liability. Therefore, whenever you create a provision, what is the entry you will write? Since it is a charge against profit, P&L account will be debit. Provision for doubtful debts account will be credit. Provision for doubtful debts. That means some of your profits will be charged against this. So the entry is P&L account debit to provision for doubtful debts. Correct? Sir, it's a charge against profits, sir. That means against the profits I created this. So therefore from P&L I need to transfer the sum amount to provision. Provision for doubtful debts. Okay. So that's it. And you know, this concept is whatever we have discussing, it is endorsing or supporting one principle. Can you tell me what is that? Yes, conservatism principle. Very good. Yesterday I told na prudence concept. So this entire concept, this provision for doubtful debts, so it is based on conservatism, or also known as conservatism concept, or also known as prudence concept. Because prudence concept says anticipate all possible. Now I think you got an idea. What is this bad debts? What is this doubtful debts? What is this good debt? Good debt, bad debt, doubtful debt. Okay, quickly, come on, tell me. When goods are sold on credit basis, generally the amount receivable from the other party, those parties are called customers or debtors, and that amount which is going to be collected from them is called debt. Hello. Now once there is a debt, there are chances. Based on the chances of collection, debts are divided into three categories. What are those? Good debt, bad debt, doubtful debt. What is good debt? Likely to be realized in full, so no worry, no risk, no loss. Next, what is bad debt? Irrecoverable, non-collectability, so it is a confirmed loss. Next, what is the third one? Doubtful debt. Collection is doubtful, whether amount will come or not we don't know. Okay, that is called doubtful. So what is the accounting treatment for bad debt? Since it is a confirmed loss, we directly written off to P&L account. Bad debts to debtors is the entry. Next, what is doubtful debts? It is a loss, a confirmed loss, a possible loss. Possible loss. Suppose if any customer not paid the amount, it is a loss for me. It is a possible loss. So therefore, since it is not a confirmed loss, can I write directly to P&L account as a loss? No. Instead, what I can do? Hello, tell me, sir. Since doubtful debts is a possible loss, I can't directly written off to P&L account like a normal loss. What I have to do? I have to create a provision for doubtful debts. That means I need to estimate the amount which is likely to be non-recoverable. Sir, how can I estimate, sir? Based on my previous experience. Companies can put policy like every year we create 10% provision on doubtful debts. Like that, 10% provision on debtors they can create. Okay. Basically, what is provision? What is provision? A charge against what? Profit. For what? For the purpose of providing for any possible loss or liability. That means in future if there is a loss or a liability, we will use this provision to set off those losses. And what is the entry when you create a provision? P&L account debit to provision for doubtful debts. And this entire concept is based on what? Conservatism or prudence concept. Now comes the most important, sir. Okay, sir. Theory we understood, sir. Now, strictly saying, sir, there are two methods, sir, for accounting of this bad and doubtful debts. There are two methods. Whatever I told you, you remember this thing. Now, next 20 minutes, most important, because two methods I am going to explain. Now, while solving, you need to apply these two methods. Okay? So, methods, write down methods, account, methods of accounting for bad and doubtful debts. Methods of accounting for bad and doubtful debts. See, carefully listen to me, carefully follow to me, because examination point of view, this is very, very important. There are two alternative methods, sir. Two alternative methods are there. Now, first method number one, I am explaining, sir. See, in method number one, provision for doubtful debts account is opened and all bad debts are adjusted against the provision for doubtful debts account. Method number one, in this method, provision for doubtful debt account is opened. Why we will open provision for doubtful debt? I told you, doubtful debts. To meet this possible loss, we will charge some amount against the profit in the form of provisions. Now, in the first method, what we will do is, a provision for doubtful debts account is opened and all the bad debts are adjusted against this provision for doubtful debts account. This is the main principle you need to remember what is happening in this method. So here in method 1, what happens is, write down a provision for doubtful debt account is opened and all bad debts are adjusted against the provision for doubtful debt. Provision for doubtful debt account. So we will open provision. There is a provision for doubtful debt account, sir. All bad debts are adjusted against this provision for doubtful debt account. Okay. Now here the entries is, first for bad debts. Suppose bad debts came during the year. Bad debts. Bad debts means any debtor has not paid the amount. Bad debt, confirmed loss. Tell me entry. Bad debts to debtors. Correct? I told you already. What is the entry for bad debts? Bad debts account debit to debtors. Bad debts is a loss which will be debited to sundry. Debtors account will be created. Why? Because debtors balance will reduce. Debtors is my asset. Since amount is not collectible, so my asset balance will be reduced. So bad debts to sundry debtors. Okay. Now next. What I told you, this bad debt I will return off against my provision. That is what I have written. See this. A provision for doubtful account is opened and all the bad debts are adjusted against provision method. See, this is one method, sir. In this method, the bad debts will be written off against the provision for doubtful debts. Anyway, we have created a provision, right? So, second one, for writing off the bad debt to provision for doubtful debt account. Writing off the bad debt to provision for doubtful debt. Now you tell me, suppose if bad debts is a confirmed loss which is against the provision, we have adjusted it. What is the entry? What entry we will write for adjusting bad debts against provision? Provision generally which balance? Credit balance. If you adjust, it will be debited. Bad debts are showing which balance? Debit. So if I adjust, it will be cancelled. So therefore the entry is, when I adjust bad debts against provision, provision for doubtful debt account debit. Provision for doubtful debt account debit. Provision for doubtful debt account debit to bad debts account will be credit. See this. That means indirectly what I have done is, whatever the confirmed loss came in the form of bad debts, I have adjusted against the provision. Whatever the provision I am maintaining for bad debts. Already in my books, provision for doubtful debts is there. P&L account debit to provision that I created already. Against that provision, this bad debts I am writing off. Okay. Now what happens is, at the end of the year again I need to check whether I am maintaining appropriate amount of provision or not. Because see, I told you, maintaining provision for doubtful debts is kind of a policy. See, I don't know how much amount is not going to be collected from debtors. So therefore most of the business organizations, what they will do is, they will follow one policy. Every year create 5% provision for doubtful debts on debtors. 10% provision like that. Is it fair, sir? Are you understanding? Sir, suppose you don't know what will be the loss. You don't know how much amount you are not going to be collected from the debtors. What is the best option you have? Tell me. Every year some amount you create a provision. Hello? And whenever loss came, adjust it. That is what they are saying. So that's why bad debts came. Already provision for doubtful debts is there. Adjust. Now at the end again I need to check whether is there any provision necessary to create to maintain my policy. For example, I decided, my business is decided to create a provision 10% on debtors. Suppose my debtors is 10 lakhs. On that 10% means 1 lakh. Already I adjusted bad debts with provision. So therefore my provision for doubtful debts has been reduced. So therefore at the end, whether sufficient provision is there or not. If it is not there, again I need to create. So for creation of necessary provision, I need to check whether sufficient provision for doubtful debts is there or not. If not there, I need to create again. So that's why the entry is for next, for creating what? Necessary provision. Creating necessary provision at the end of the year. Creating necessary provision at the end of the year. Tell me, suppose when you want to create a provision, what is the entry? Suppose provision should be created for some amount. What is the entry? What is the entry for creation of provision for doubtful debts? P&L to provision. P&L to provision. P&L to provision. Already explained here. For creation of provision, what is the entry? P&L to provision for doubtful debts. Watching like a movie. No response at all. Not connecting the subject. Please be here. Don't put your bodies. Mind also should be here. So when you create a provision, what is the entry? P&L account debit to provision for doubtful debts. Provision for doubtful debts. Provision for doubtful debts. And generally, sir, when you are creating a provision, you create a provision on sundry debtors after adjusting bad debts. Because bad debts is anyway loss, it will not be collected. So only on the remaining balance you need to create a provision. Suppose your debtors is 10 lakhs, 2 lakhs bad debts. So therefore 8 lakhs is the sundry debtors. On 8 lakhs you have to create a provision. Will you create provision on 10 lakhs? Because in that 10 lakhs, the 2 lakhs bad debts is also there. Already bad debt. How can you, why you create a provision? It is a confirmed loss. Correct? So generally provision is created on the basis of sundry debtors after adjusting bad debts. Generally this is done after trial balance. After trial balance. So after trial balance we will see what will be the bad debts, what will be the debtors. So from the debtors, if I reduce the bad debts, I will get the balance figure. On that I create a provision. That's why, can I tell you one important point? That's why creating provision for doubtful debts is what? Adjustment entry, like depreciation. Actually, if you remember, we are discussing still that accounting cycle. Accounting cycle, identification of transactions, recording in journal, posting in ledger, then unadjusted trial balance, then adjustment entries. Actually, we have discussed unadjusted trial balance. Next, we need to discuss adjustment entries. Actually, this concept of provision for doubtful debts is where? You see, this concept of accounting treatment for bad debts and all, you see my material carefully, where I have given these topics. See this, I will show you. See, adjustments and rectifications. Even depreciation is also what? Adjustment. I told you, at the end of the year we need to create a depreciation, we need to provide. Otherwise what happens, tell me? Suppose if I don't create depreciation, if I don't create provision for doubtful debts, what happens? What happens is my P&L account will not show correct results. That's why some entries we will not record directly in the journal like a normal transaction. These are not normal transactions. Depreciation, closing stock, provision for doubtful debts, all these things we have to do at the end of the year as a adjustment entries. And one more important thing, where these are all recorded? This point also I told. Very good. General proper. Correct? Yes. So what we are discussing? Provision for doubtful debts. Okay, come back. So these are the three entries. So tell me, what is method number 1? What we do in method number 1? We are going to adjust the bad debts against provision for doubtful debts. Now in this case, entries, bad debts, what is the entry? Bad debts to debtors. Next, adjust bad debts against provision, what is the entry? Provision to bad debts. Now at the end of the day, you have to check whether the provision for doubtful debt sufficient is there or not. Suppose if you want to create a provision, what is the entry? P&L to provision. P&L to provision. P&L to provision. That means, see here, if I prepare provision for doubtful debts account, everybody please listen to me carefully. If I prepare here provision for doubtful debts account, see this, carefully observe, everybody learn the subject. Provision for doubtful debts, first opening balance, correct? Suppose on 1st April 2024, opening, by balance, brought down, opening. Suppose opening doubtful debts 1 lakh, sir. 1 lakh. Oh, 1 lakh. Opening doubtful debts 1 lakh. They will given. Now during their bad debts came. Bad debts, suppose 40,000 is there. What is the entry? Bad debts to debtors. And then bad debts is adjusted to provision. So provision for doubtful debts to bad debts. So in provision for doubtful debts, I will write. So suppose for example during the year 24-25 we got a bad debts. So two bad debts, I am adjusting my bad debts against provision. Suppose bad debts came 40,000. Okay. Now what is the balance? 60,000 balance is there. Now see 60,000 balance you cannot write. At the end you have to check. Suppose the company policy is maintain provision for doubtful debts. For example 10% on debtors. How much? 10% on debtors. For example debtors balance is 10 lakhs. Minus bad debts during there how much? 40. So what is the balance? 10 lakhs minus 40. 9 lakh 60 into 10%. 90. This is the balance we need to maintain. See this. This is the balance we need to maintain. Everybody. So what is the provision you need to maintain? 96,000 at the end. But what is the balance in your account? See this. Actually, your opening balance is 1 lakh. Already 40 adjusted. 60 is there. But you need 96. So how much increase? 36. That will now created. The entry is P&L to provision. So therefore, at the end of the year, 31st March 2025, by P&L you will write. How much? 36,000. So this is the provision we create during the year. Now tell me whether you have understood the concept or not. Hello? Sir, closing how much I need to maintain, sir? 96. What is my opening, sir? 1 lakh. Bad debts already 40 adjusted, sir. So therefore still how much provision I need to create? 36,000. Sir, this you can solve by statement also. They will ask you sometimes how much provision during there, how much provision is created, like the 2 marks MCQ they will ask. So what you have to do is, I will tell you simple formula. See this, like this you need to calculate. Closing provision, add bad debts minus opening. Then automatically you will get how much provision required to be created. Or else you can do like this also, account type. You understood this way of solving? Account, opening this side, closing this one. This is bad debts adjusted. Balance figure is nothing but provision required to be created. Hello? Or else you can do it in another manner also. What is that? See, simple, like this. Closing provision required, how much you calculate? Closing provision required. How will you know how much closing provision will be required? They will give in the question. Closing provision required. For this, what I need to add? Bad debts adjusted. Bad debts written off against provision. Add it. Bad debts written off. Bad debts written off. Total. Actually, bad debts written off total. Then automatically you will get one amount, right? From this you need to reduce what? Opening provision. Correct? Opening provision. Automatically you will get what? Automatically you will get provision required to be created, which is nothing but amount to be charged to P&L account. Correct? I will show you. See this. In this case, in the example I selected, what is the closing provision? 96. What is the bad debts adjusted? 40,000. What is the total balance? 1 lakh? 36. What is the opening? 1 lakh. So how much provision required? That's it. Simple, na? This is also, this way also you can do. This they will ask for 2 marks. I think now you got the concept. Provision for doubtful debts, I am explaining 2 methods. In this, the first method is this. What is the crux of this method? The crux of this method is bad debts is adjusted to provision. So 3 entries. First bad debts entry. Then bad debts is adjusted to provision. Then create the remaining provision. How much provision I need to create? You know. Closing, add bad debts minus opening. Or just you prepare this account. Automatically you will get. Hello. Now, I am going to tell you second method. One of the most important methods, second method we are discussing. So next, method 2. Write down, method 2. method 2. Now, in this method, sir, all bad debts will be written off to P&L account, not adjusted against provision for doubtful debts. Rather, what we do is all the bad debts will be written off to P&L account. Okay? Whatever the difference is there between the opening and closing provision required to be maintained, that will be adjusted through P&L account. In other words, if closing provision is more than the opening provision, we require additional provision that is charged to P&L account. Okay, okay, very simple, very simple, very simple, not at all difficult. Actually, most of the students are feeling difficult. That's why I'm explaining in detail. Please carefully observe. See, here you need to write down all bad debts are written off to what? Written off to P&L account. All bad debts are written off to P&L account at the end of the year. At the end of the, okay? And the difference between opening and closing, the difference between opening and closing provision is adjusted through P&L account. That's it. Is adjusted through P&L account, sir. Adjusted through P&L account. Only these 2 points are important. So another method is whatever the bad debts are there in the business, whatever the bad debts came, just directly transfer to P&L account. Generally. And compare opening, how much is the closing I need to maintain. The difference is adjusted through P&L account. Nothing but. Suppose my opening provision 1 lakh, closing I need to maintain 2 lakhs. That means extra provision I need to create 1 lakh. That will be created through P&L account. Like how this 36,000 created here in method 1, like that. Simple. So the difference between method 1 and method 2 is what, sir? In method 1, bad debts is directly adjusted to provision. And the amount of provision required we calculated accordingly. But here in method 2, bad debts is directly transferred to P&L account, not adjusted to provision for doubtful debts. See, here the entry says, say this. First, for bad debts, what is the entry for bad debts? Yes, bad debts to bad debts account debit to debtors account. I mean sundry debtors, nothing. Sundry debtors. Next, for writing of bad debts to P&L account. Bad debts we are writing to P&L account, sir. So what is the entry? P&L to bad debts. Bad debts to P&L account. Sorry, P&L to bad debts account. Now finally, for creating necessary provision. For creating necessary provision at the end of the year. Creating necessary provision at the end of the year. How much provision I create at the end of the year? Simple. Suppose if my closing provision required is more than opening provision, I need to create it now. P&L to provision. Suppose if my opening provision, my closing provision required is less than the opening provision, whatever the excess provision is there, that I have to return off. That is provision to P&L. See here, simple. At the end, I need to check what is the closing provision I need to maintain. What is my already opening provision is there for bad debts, for doubtful debts. So here 2 possibilities, sir. If closing provision required is greater than opening provision, Then what I need to do? I create a provision. What is the entry? P&L to provision. Provision for doubtful debts. Next one, if closing provision required is less than opening provision. Less than opening provision. Then whatever the excess provision is there, what I need to do? Reverse. Provision for doubtful debts to P&L account. Provision for doubtful debts to P&L account. Okay. Suppose, sir, very simple, sir, here. Suppose my closing provision required to be maintained is 1 lakh, sir. My opening provision is, suppose for example, 90,000 is there. That means how much I need to create now? Opening already 90 is there. Closing I need to maintain 1 lakh. 10,000 I need to create. So what is the entry? P&L to provision. 10,000, 10,000. Because I told you now, we have a policy that we need to maintain this much provision every year end. So therefore at the end of the year we need to check what will be the closing provision we need to maintain. What is our opening provision? So how much balance required? If it is required, then it is created from P&L account, P&L to provision. Suppose my closing provision required is 1 lakh, sir. Already opening I have 1.2 lakhs. Then what I need to do? Excess provision will be written off. 20,000. Provision to P&L account, 2020. Because when you create a provision, you charge it against profit. The same provision reversed means it is directly go to P&L account. Hello. That's it. So therefore tell me, in second method what we are doing, sir? First of all, the bad debts will be adjusted to provision or directly transferred? Directly transferred to P&L account. And the difference between opening and closing provision is appropriated against profits. I mean, we will create a provision. That's it. So first bad debts came, bad debts to debtors. This will be transferred to P&L account. And at the end, we will see whether necessary provision required or not. If provision required, we will create. If provision is not required, we don't create. Everybody. Now, sir, what is the presentation of this provision for doubtful debts? How we are going to present? See, the presentation is when you prepare balance sheet, na sir, important, listen to me. When you prepare balance sheet, na sir, sundry debtors you will take. Sundry debtors. From this sundry debtors, we need to reduce provision for doubtful debts. Because these are provisions created against assets, sir. Assets. When you create any provision against asset, na sir, in the balance sheet you need to show by way of reducing from that particular asset. That's why provision for depreciation, provision for doubtful debts, these are all shown by way of reducing from that particular asset. See, when you create a provision against liability, that will be shown on the liability side. But when you create a provision against asset, that will be shown by way of reduction from that particular asset. That's why provision for depreciation. Even provision for depreciation also, when you are presenting balance sheet, you need to reduce from the particular asset. Sir, these are all provision against assets. Assets, debtors is my asset, right? So on the asset side, this provision will be shown by way of reduction. Don't show it on the liability side. It is not a liability. Liability means something we need to pay. Are we required to pay to anybody here? Just my collection is not coming, some amount. That's why I create a provision. See, this is my possible loss. That's why I'm reducing. That means I'm indirectly saying to the users that, see, my debtors is 10 lakhs, but my provision is 2 lakhs. That means this 2 lakhs may not recover in future. Therefore, you assume only 8 lakhs is my asset. 8 lakhs is my asset. And one more thing, sir. When you are presenting debtors in the balance sheet, sir, if at all there is any bad debts, bad debts will also be reduced. Bad debts during the year will also be adjusted from the debtors only. So from debtors, bad debts will be deducted as well as provision will be deducted. Why? Bad debts is a confirmed loss. It will not be recovered. Therefore, my asset balance reduced. Provision for doubtful debts means possible loss. Both will be reduced. This is the classic example of conservatism concept, sir. Which concept? Conservatism concept, classic example. So I think you understood both the methods. Of course, I am going to solve one question also. But you understood the basic theory. Now once again you tell me. So what is the concept we are learning? Provision for bad and doubtful debts. Correct? How many methods? 2 methods I told you. What is the first method? What is the first method? Bad debts is written off against provision for doubtful debts. So when there is a bad debts, what is the entry? Bad debts to debtors. When you written off against provision, provision to bad debts. And at the end, you need to create a provision. So P&L to provision. How you are going to create a provision there? Closing provision required, add bad debts minus opening provision. Automatically you get the provision required to be created. Now what is the second method? Bad debts is directly written off to P&L account. Don't written off against provision. So what is the entry for bad debts? Bad debts to debtors. Then bad debts will be written off to P&L. What is the entry? P&L to bad debts. Now at the end you need to see whether if closing provision required is more than opening, create a provision. P&L to provision. If the closing provision is less than the opening provision, written off. P&L provision to P&L account. And how you are going to show these provisions in the balance sheet? By way of deducting from the debtors. Sundry debtors minus provision for doubtful debts minus bad debts. These are all shown by way of reducing from the asset. I told you the reason also, because these are not liabilities. These are against assets possible losses. One is possible loss, another one is confirmed loss. No. Here one more important concept I will tell, sir. Simple concept only. That is recovery of bad debt. What is that? Recovery of bad debt. Recovery of bad debt. What is this recovery of bad debts? Suppose once there is a bad debt, that is the confirmed loss, you recognized it. But suppose later on it is recovered from the customer. For example, I sold goods to Purna. Now Purna has not paid the amount. Later someone told him, or later he became a so rich person. Now he got a thought that he want to make the payment to me. Now he made the payment. I didn't expect this. I thought actually it's a bad debts. Then what I need to do? When I recover a bad debt which is already written off, what I need to do? What is the entry? Bank to bad debts. Already you have written off here. Written off in the sense, bad debts to sundry debtors already you have written. Bad debts to debtors you have already written. Already bad debts. Recovery means what? Bad debts written off in earlier years. Already, suppose last year, 2 years back only bad debts written off. Now in the current year that is amount is received. Now see, whenever any written off bad debts are recovered, we need to treat them as income gains. That means it will be directly credited to P&L account. So therefore the entry is cash or bank account debit to bad debts recovered account. Bad debts recovered to P&L account. Bad debts recovered to P&L account. So when there is a recovery of bad debt, what we need to do? Directly credited to P&L account. Directly credited to P&L account. Okay, that's it, sir. This is also one small concept. Because see, why recovery of bad debts is directly credited to P&L account? Because already loss recognized, na. So therefore it is a collection later. It is not, no way has to be linked with the previous bad debts. It has to be seen as a fresh receipt. So therefore, cash or bank to bad debts recovered, bad debts recovered will be directly credited to P&L account. So this is the theory concept, sir. Now I am going to explain. I will take one example and I am going to solve how this will work out. Okay, we will solve some questions relating to it so that you will understand it.